Welcome everyone to another session of At the Table with me, Rick Grantham. Typically discuss just issues in the world of selling businesses. I think the recent sessions we've had have been around particular deals and how those have gone. And today is maybe coming a bit earlier in the process, trying to just chat to Nitish and Taryn, two very experienced deal makers at Deal Leaders International, to just ask them a little bit more about what happens before you go to market. So perhaps just as an introduction, Nitish first, if you wouldn't mind just giving us a brief introduction of what you do at Deal Leaders, and then we'll go on to Taryn.
Thanks, Rick. Thanks for having me at the table. So I'm a deal executive at Deal Leaders International. Basically, my role is really to work on a deal end to end, get involved early on, in some cases before a client is signed up, all the way right to the end, when the money is exchanged. And really after that as well, I guess our goal really is to have a client for life. So it's about maintaining those relationships through the deal and afterwards. But that's just a quick brief. Taryn, I'll hand over to you.
Thanks, Nitish, and thanks, Rick, for having me today. My role in a deal is very much to support a deal executive. And what we do is, from a financial perspective, working on building the model, really understanding the numbers, what's driving the growth, and also all through the transaction, helping on the valuation and building out the IMs, etc.
Yeah, I think, and just also, one of my challenges here is I'm speaking to two CAs. I'm not a CA, so we've got the full accounting team. Well, not the full accounting team, but two very sharp people in the room here, hopefully going to share some wisdom with us around getting businesses ready. The topic today is around decisions that shape your exit. There are lots of things that go into shaping the exit, being ready to exit. I think my caution mostly is there's always a reason not to exit. In fact, the challenge that most business owners have is the complexity of their stakeholders. They've got husbands or wives, they've got children and family involved in some form or another. They're stakeholders, effectively stakeholders in their business. They've got employees, they've got senior executives, and they've got other shareholders. So the world of an exit is complicated before you even start. But I think today we're just going to focus probably a little bit more on the practical elements. We also, given that the timing coming towards the end of February is always an interesting time as to, for those February year-end businesses, what does my balance sheet need to look like? So there's lots to talk about. But at the same time, to balance that with what gets solved in the process of selling your business and what has to be resolved before you engage in that process. So perhaps starting with you, Nitish, just off the top of your head, someone says, am I ready to sell? What are the key things that you would want to know before in order to assess their readiness?
Yeah, thanks, Rick. I think, if I have to put it down to 7 key points we always look at, the one thing is the why, really understanding the objective of why you want to sell or get a strategic partner, or is it a full exit, or do you need capital injection and therefore getting a partner that can fund out your growth potential. So that's a critical element, just understanding the why. And then from there, it's also just understanding who the management team is. Is it the shareholders of the business that's running the business? Do they have effectively a second tier management team? We can go into detail on all of these points. So just to keep it brief, the third point is really your financial health check, which I'm sure Taryn can give a lot more detail into, but just understanding how up to date the records are, are they audited financials? Are management accounts received monthly? Those are some of the key elements, besides going into detail of really analyzing the trends, etc. And then, for us, just understanding from that basis, if the business has projections, and if they don't, that's fine. Those are things that we get involved in with clients. And, critical element is business efficiency. So really understanding the key performance indicators in a business and how those have trended over the last year or 2 years. And then last 2 points that really cover our 7 critical areas is understanding risks in the business and how those have been mitigated historically, and also some that potentially are still open. How do you deal with those in a deal situation is an important part. And then every business is unique. So it's really analyzing the specifics of that business and industry. And our discussion today will be quite broad, but I would urge probably to have a meeting with some of us if they are interested in looking to exit or finding a partner from a capital perspective.
Thanks, Nitish. And Taryn, Nitish touched on forecasting. Maybe just tell us a little bit more about, firstly, why is it important? And how do you solve it if you're a business that doesn't forecast? I mean, probably 70% of businesses I come across just don't forecast. It will be what it'll be. But tell us a bit more about why it's important to take that thinking a little bit further and get into more detail.
Yeah, Rick, you're right. We do very often come across businesses where they don't prepare budgets. They really don't look further than next month in terms of where the sales are going to come from or what does the business look like. So it's not an unusual situation. And why is it important? It's because you really need to tell the story of where's the growth going to come from moving forward. What are you actually selling at the end of the day? A buyer would want to know what is the next step in terms of growth and how are we going to double the profits of this business? Is there a game plan? And the clearer you can get on that story and explaining the story, the more enticing and interesting the business is going to look to a buyer, because then they can get it. They can see, okay, cool, we've got a strong business that has a plan. They know how they're going to get there. And it's then just about how can the right buyer enable that. So when we look at forecasting, I mean, we come in and we look at what has been driving the growth historically and trying to unpack in terms of the product categories, what's been performing, what's not been performing. Has it been an opportunistic growth in the sense that the market has just been performing better, the macros have been better, consumers have more money, so they're spending more money? Or is it something deliberate that you've been doing with your sales team, maybe targeting specific customers or specific regions? Maybe you don't sell into the Western Cape and now you've deliberately gone and sold into the Western Cape, because that's also part of the story. It's not just about the business has been performing well and everybody's performing well. It's this business is actually doing better than their peers because they've got this growth plan and they've actually executed on it. Because again, if you can do it historically, it's more likely that you would be able to actually execute on whatever plans you have moving forward. So then obviously when you are mapping out that forecast, we will sit with you and understand, okay, what are the opportunities that's within your reach and capability, and what are the growth opportunities that you could unlock with the right partner. So it's not only about what can the business do on its own, it's about where's the next frontier and where do you need help. So unpacking that a little bit. And it's not necessarily going to reflect in the numbers, but it's part of telling that story.
I think it just creates certainty, and it's incredible how many businesses operate, for example, without any form of a CRM. In fact, some people don't even have a spreadsheet to kind of monitor where their growth is coming. But they often forget that they're selling. The buyer doesn't necessarily know their business that well. And so you've got to have a good story behind your numbers. And not to forget that many buyers want to do a DCF valuation on a business. Well, how do they do a DCF if the future's a complete thumbsuck? So you do need to build some logic into that and know where it comes from. And my advice is get a simple CRM and start using it as soon as you can in a business. Even if you think you don't need it, chances are it's going to add a lot of weight to your vision and your forecast. And Nitish, you talked briefly at the beginning of your 7 points around kind of where to with this business succession and things like that. Firstly, what needs to be in place? And secondly, how does a deal solve succession problems in your experience?
Yeah, thanks, Rick. Yeah, I think firstly, in terms of what needs to be in place, we've looked at a few deals we've worked on, some even with you, where the management team that is the shareholders in the business effectively at retirement age. And, ultimately they're at the point where they are looking to pass the baton on to someone. But it's very difficult at that point in time sometimes to get the right partner who potentially doesn't really understand the business as well as the shareholders who have lived and breathed it for 20, 30 or 40 years. So a critical part there is really just earmarking or picking out the second tier management team in the business and trying to bring them up, not immediately, but something that you work on a journey on. Generally, succession planning, they talk about the journey that takes a couple of years to really bear fruit. So one is just from that perspective, within your organization, are there people that you could over time bring to the table? And that's the story you'd bring in a deal transaction perspective. Or is it something that you really need externally? And that's also where, to your second part of your question, a big part of our market approach strategy is not just about finding buyers that are focused, that have only money. A critical element is the strategic value they bring. And therefore, a lot of those type of potential risks in the future could be mitigated by bringing the right buyer at the table and seeing the level of expertise they have within their stable that could take this business forward. So definitely there's no one shot at the right approach, but it's definitely something that any business should think about, start thinking about, even though they might not have a solution at the table as yet.
Yeah, I've definitely seen that. It's quite interesting because some people, I think a lot of founders and entrepreneurs are actually just not that good at finding their successor. They're good at finding managers to work under them, but they're not really that good at finding executives to take over from them. It's a different skill set. And I think what people forget, they think that the buyer needs to be able to do their job in order to take over. But actually, the buyer's skill set, and it often is the case because the buyer is in private equity or investment holding company, the buyer's skill set must be able to help them find their replacement. And that's tricky. You often find situations where, for example, some founders pay themselves very well, some don't. They don't need that much. They're quite wealthy. They don't pay themselves very well. And now they face this problem where they've got to find their successor and pay them more than they've been paying themselves. I mean, that's unheard of for most founders. But making that decision alongside a co-shareholder who has experience in finding those type of people is a much easier decision. And it's also being done by someone with skin in the game who's taking risk alongside you as you earn out of your business, or you hold a small stake over time to reduce risk for the buyer. So there definitely are scenarios. I mean, interesting, a business that we sold a few years ago was Herald's Electrical, and the two eldest sons in the business, or not eldest, but most senior sons playing senior roles in the business, initially thought they would exit. They stayed in the business, and the fact that Adenia bought, I think it was 78%, they stayed in. And not only did they solve the succession plan, they solved the growth plan through that whole move. So there often are cases where the new shareholders know how to manage better. They know how to manage executives better. And an interesting one in that, they also knew how to get rid of all the sort of false walls that had been built within the business, which actually constrained it. So the right acquirer can solve succession problems in ways that I think founders don't expect because they haven't really seen that as being the solution up to that point. Taryn, back to you. We're coming towards the end of Feb. What does a balance sheet need to look like? I don't think this is a massive lever in the world of selling a business, but given the timing, quite an important thing to look at is what should I be thinking of as a business owner, thinking, well, I might be selling in the next 12 months. What do I need to sort out? What should I change?
When it comes to preparing your business to sell, you do want to put forward a balance sheet that is as core to the business operations as possible. So if you have any balances on there, if thinking about related party loans or shareholder loans, or if you maybe haven't provided for certain sort of leave pay provisions or bad debts or obsolete stock, it's a good time to really have a look at the balance sheet and try and clean out what you can, because an acquirer will want to see, okay, what are the true assets of the business? What are the true liabilities? And we need to just make adjustments where possible, because it's easier to then negotiate from a clean balance sheet instead of trying to say, okay, this is the picture, it's a little bit muddied, we need to adjust for this and remove this afterwards. But saying that, do also have the conversations as we go through the process with the acquirer, because sometimes it is a case of, depending on the structure, are they buying the business, are they buying the shares, what assets are they taking, and what's being left behind, it does also impact. You don't have to do everything right now.
And what about cash and working capital?
So working capital is always the last arm wrestle, we like to call it. Having the optimal level of working capital, it can be tricky, but it is worth understanding over a 12-month period or a 24-month period. What does that average cycle look like? What is the working capital that's required for the business to operate as a going concern? A lot of businesses that we work with actually are carrying a bit more stock than they probably need to be carrying, and that's just to avoid stockouts. I mean, there's been a lot of delays and uncertainty surrounding the ports, and yeah, so they do tend to hold a bit more stock. So if we are coming to the point of selling, it is going to be a conversation of, is that stock really required, or can it be converted to cash? So looking at that, looking at, do you have excess cash? Again, a lot of businesses we work with, they don't like funding growth through debt. They like to keep the cash reserves in case they need it. So oftentimes it is that there's a dividend that could be declared before year end just to clean out a lot of that excess cash. So you're not going into a transaction with a very high cash balance and an acquirer thinking, okay, that cash is actually needed for the business, when it was really just a safety net for in case.
Yeah. And what I find always interesting with acquirers is they tend to, the most kind of, in their minds, the most true set of numbers is the last audited financial statement. So that is going to live with you for a year. That if it's end of February 2026, those numbers, whatever you have there, is going to live with you for a year. So you kind of, it is definitely worth spending a bit of time on it. It isn't a deal breaker. We make a ton of adjustments to income statements and balance sheets and how we present them. So you can solve most problems later. But yeah, I always feel like people forget to change gear sometimes when they go into this business. I actually want to sell this business versus it's my lifestyle business, or it's my, I'm so focused on tax that I forget about the optics of what it looks like. And maybe that kind of brings us to a critical part of a sale. And I've got split ideas about this myself. But Nitish, tell us about being DD ready, being due diligence ready. You're thinking of selling. You're not really sure because of things you've done before and the way you've run it. And I think probably, thinking back, probably the Cobra deal is a good example of some of the sort of tough things they had to go through when they got into the world of warranties and things. How do you get a business due diligence ready, and when's the time to do that?
I think, Rick, it's a critical question, but also it's one of those where analysis paralysis can kick in, and doing too much too early can almost be a deterrent to getting things moving in the right direction. An element of the work we do in our foundation phase, or as we sign on a client, is really somewhat a big part of the financial DD that we cover as we analyze your financial statements, management accounts, CRM reports, product listings, etc. Just to gauge, firstly, understand the business and the commercials, but make sure that things are tying up. Things do reconcile between certain key reports and financial statements. So understanding those and the reconciling items is a critical element. And that's work that we do initially as part of our material preparation work, because from our perspective, we also don't want to send out information that's incorrect or effectively not something that an investor could rely on. So it's critical for us. So we do a lot of that initial work. And then once we have the right type of buyer at the table, I think the critical thing is if there is alignment on valuation and structure and other critical elements around succession, what the roles will be going forward, then there's a DD plan that's ultimately drawn up by the buyer that we get involved and try and make sure we understand with the seller and really handhold through that process. What are the key things the DD providers will need as part of their DD? And it's going a level deeper to what we would do initially. But at the same time, a lot of that we believe we've ultimately accumulated over time, and it's something that we'll cover. In terms of the transaction that you mentioned, many elements from a due diligence perspective down the line, especially from an ESG perspective, you're looking at creating new rental agreements with landlords, the warranties and indemnities that come with a business of that nature. it's very difficult to solve those initially. It's something that was done subsequently, almost by a line-by-line basis, if you want to call it, an agreement between the buyer and the seller around the table. And where relevant, getting lawyers involved, ensuring that the drafting is appropriate. But as long as the commercial understanding between buyer and seller is there, that's a critical element for us to make sure that the deal's driven forward as intended. I hope that answers to some extent the question, but I know you've also have mixed views on that point.
No, but I think you are right. I think trying to, listen, there's some obvious things, that you've got to get right up front, and you've got to, things must stack up. I think our experience of problems in DD generally come from actually accounting issues, and they come back to balance sheet, they come back to stock, they come back to those type of things. Those are the ones that really hit you hard. All the other stuff is very solvable in your DD. You can solve it when it comes. We'll pick up a fair amount of it through the process. We can give advice about fixing that through the journey. You don't have to kind of do a DD first in order to go through the process. You can fix it. But accounting issues, particularly where there's a trend of writing stock off in February and reinstating it in March and things like that, those are nasty holes that you can fall into. So I think there's an awareness of those things that one's got to look at carefully, get the auditor, the accountant involved to be sure that that's all stacking up. And because there are some pretty dark corners things can get hidden in, and you've got to make sure they're not hidden, because they're going to come out one day, and you've got to make sure that that's fairly transparent. So I suppose maybe that's the answer to DD. No, make things transparent. Don't hide things. Don't hide things from us, and don't hide things almost from yourself, because you'll be so used to putting them away in a dark corner. You've got to let them out. You've got to make sure everyone's on the same page. Just probably our last point, Taryn, just to wrap up on another area that we've certainly had, for those who aren't aware, we have a process which some people choose to take up in the beginning called the foundation phase. And it really is about all these issues of being ready. Are you ready to go to market? It covers all of the stuff we're talking about here. Structure is an interesting one. We've got an interesting business which we're actually going back to the business saying, you actually have to solve a few things here before we carry on. But Taryn, maybe more broadly on the topic of structure, what are the big issues? What's a complete no-go, and what can we manage from a structure? Now, particularly thinking about multiple entities, consolidated accounts, etc. What are your thoughts and experience there?
So obviously a clean structure is ideal, but again, I know you start with a small structure and then you add a trading entity or international entity, and it does kind of grow over time. So really just taking a critical look at what is the purpose of the structure? Is it set up that way for a reason? And maybe can we simplify it? And what we like to do when we are in prep phase is also just say, okay, what is for sale? Because sometimes we're not selling the whole group. And how do we present it? Do we need to consolidate it? Do we show it separately? And I think the big thing is, do you know what the consolidated view looks like? Have you got a consolidated set of accounts? And do you understand the intercompany transactions? Because oftentimes there's management fees and there's intercompany sales at maybe different margins, and it can get quite complex. And it's really about being able to present a clean consolidated view where you can say, this is the actual clean gross profit margins, and this is what the business is doing without all of this related party noise. And another thing is, if there's a need to formalize some of those related party agreements, we've got 1 or 2 clients at the moment where there are maybe some shared services in between the entities that were never formalized, and it's about understanding how does that number get calculated, what are the costs that actually need to sit the entity that's being sold, and do we have a handle on that? Because if we don't, the negotiations do get a little bit tricky down the line in terms of trying to explain it to an acquirer.
Yeah. I must say that issue of consolidated accounts, it still amazes me how many companies, owners run multiple entities without consolidated accounts, without a single view of the truth. I think it's really worth it. It's not a massive accounting cost. It's always seen as a big accounting cost, but a single view of the truth. It's really hard to run a business. Maybe they start small and it doesn't feel like it's important, but trying to get to a single view is important. We often do it in that foundation phase. We do it for you. We help you get that single view. But from there forward, we really want we ideally like it to be done through the accounting process rather than as an exercise. And this leads me to a point which I'm amazed again at what we find. How many companies take an incredibly long time to get management accounts out? Ideally, you want to be certainly within the following month. Ideally, halfway through the following month, you want to get a full set of accounts, which doesn't need a whole lot of adjustment to get a final view. And I'm shocked at what I find, particularly in the construction industry. We've seen it. Some other sort of more food processing, a recent food processing business, where there's just no single view. It's almost like you're trying to run a business or sell a business, and all you've got is a rearview mirror. You can't get a proper view through the windscreen. Consolidated sets of accounts and good management accounts are critical. I just want to finish off on a topic, because I think this whole topic we're discussing might be confused with trying to time your exit. We've recently had a software business go to market. Obviously, the market has been in turmoil around software because of AI interruption in that space. And I go back to remembering when the guys first approached us a year and a half ago, and they were ready. They were absolutely ready at that point. And they kept looking for other reasons not to go to market yet. And basically, they didn't do much for a year and a half. They did actually try to sell on their own. That probably didn't help. But ultimately, they lost the window. I think there's generally a feeling like, well, we're on this trend, it's going to carry on. It might not carry on. And I think the truth is, if you're ready, you're ready. And if you're almost ready, you're probably still ready. You don't have to solve everything. But don't assume that the market's going to stay like it is. Don't assume that your business environment is going to stay. There are lots of curveballs. Get in the market and do it properly. But there might be reasons why you choose to stop during doing it properly, because you're going to learn a lot. You don't have to follow through. No one's ever forced to do a deal. But get in the market and find out what the market thinks of that business, rather than kind of almost finding reasons to delay it continuously. Invariably, that doesn't end in a happy scenario, because too much is going to change between now and when you are in the market and you're trying to get an offer and you're trying to close the deal. And that's really the pinnacle. And that takes a while from when you make a decision to actually happening. So don't add too many reasons to delay. Focus on the important stuff and put a good deal together and put a good market approach together. Nitish, any final comments? That might have stimulated all sorts of thoughts in your head, but I think we are close to out of time. So maybe just a minute each to close out.
Thanks, Rick. Yeah, I think your concluding remarks, it's really just around getting in touch with us, because every business is unique, and for us to really assess the business on its own merit. And the reason why we're really there is the process of selling is a full-time job on its own. So while you're running the business, you also want to sell the business. To try and manage those hats in such an important liquidity event for yourself, for other shareholders within your group potentially, and the employees of the business for the continuity of the business. It's such an important decision. So entrusting it with people who have done it in the past and whose sole job is to do it is something worth considering. So I'll leave that thought to people who are listening to this.
Did right. Taryn, anything to wrap up?
From my side, I think it is a case of get us involved early, because a lot of problems that you think are problems are not actually. They can be solved through the process. And it's really just about understanding from the buyer's point of view early, what is the buyer going to look at? Do you have those documents and reports ready, or can we help you get there? And what's really important, because Rick, to your point earlier, they might be thinking we need to solve this before we can go to market. And meanwhile, the market doesn't even care. They can fix that themselves within their own structure. So yeah, it's really just, we know what the market will look at, and we can help you understand how it's going to show up in practice.
Yeah. It's interesting, actually, you mentioned about solving it in the process. Talisman was an interesting example where we had a very, very complicated structure, and the process of selling was able to solve the structural issues. They were almost impossible to fix beforehand. The process of selling meant we had to really understand and present them properly, so we solved it there, and then we were able to find a buyer who not only made the best offer, but was also willing to help to handle those structural issues. So you're absolutely right. It is about using that as part of your process, to solve it as part of your process, and get the right buyer to support that process as well. Last comment from me, remember that our foundation phase gives answers to all of these issues. And what's really important is you don't have to do it as part of a mandate. It's simply a service that we offer for a fee, and it's a standalone service. It's not part of a mandate. It's not locking you in to another process. And it really does solve for all of these points that we've discussed today. Thanks very much, Nitish. Thanks, Taryn. And until next time.
Thanks, Rick. Thanks, Taryn. Cheers.
Thanks, Ray.
Yes.